This is a demonstration of problem 340B, journalizing adjusting entries and identifying the impact on financial statements. Harrison Fishing Charters has collected the following data for the December 31st adjusting entries, and the problem gives us information on 5 adjusting entries. The requirements state, first, to journalize the adjusting entries needed on December 31st for Harrison Fishing Charter, and assume that Harrison records adjusting entries only at the end of the year. So we're going to start out with the adjusting entries. So A states that the company received its electric bill on December 31st for $375, but will not pay it until January 5th, and we're to use the utilities payable account. So our debit will be to utilities expense for $375, and our credit will be to utilities payable for $375. Our explanation will be to record utilities expense. Our B states that Harrison purchased a 3-month boat insurance policy on November 1st for $3,600, and Harrison recorded a debit to Prepaid Insurance. So we purchased a 3-month policy for $3,600, so that's $1,200 a month. 2 months have gone by since we purchased it, so we're going to need to record $2,400 of insurance expense. So we're going to debit insurance expense for $2,400, and we're going to credit prepaid insurance for $2,400. Our explanation will be to record insurance expense. C states that as of December 31st, Harrison had earned $1,000 of charter revenue that has not been recorded or received. So we need to debit accounts receivable for $1,000 and credit service revenue for $1,000, because these are amounts that we have earned but we haven't collected. And our explanation will be to accrue service revenue. D states that Harrison's fishing boat was purchased on January 1st at a cost of $56,500. Harrison expects to use the boat for 5 years and that it will have a residual value of $6,500. Determine annual depreciation, assuming the straight line depreciation method is used. So when we use straight line, we start off with the cost, $56,500, subtract the residual value of $6,500, and that gives us depreciable cost of $50,000. We divide that by the useful life of 5 years, and we get depreciation expense of $10,000 a year. So we're going to record, debit our depreciation expense boat for $10,000 and credit accumulated depreciation boat for $10,000. Our explanation will be to record depreciation on boat. E says that on October 1st, Harrison received $5,000 prepayment for a deep sea fishing charter to take place in December, and as of December 31st, Harrison has completed the charter. So when we received the money, we would have credited unearned revenue. So now that we have completed the charter, we're going to debit unearned revenue for $5,000. And now we're going to record the service revenue for $5,000. And our explanation will just be to record service revenue earned that was collected in advance. Okay, so those are the 5 adjusting entries that we needed to make. The B part of the problem says, if Harrison had not recorded the adjusting entries, indicate which specific category of accounts on the financial statements would be misstated, and if the misstatement is overstated or understated. And they give us a table as a guide. So they're telling us first to give the category of the accounts on the balance sheet and whether they would be over or understated, and then the category on the income statement and whether they would be over or understated. So if we look at the first entry, we see that we had debited utilities expense and credited utilities payable. So what they're asking us is, if we had not made that entry, how would that have affected the balance sheet and the income statement. Well, we know that if we had not recorded the utilities expense, then our expenses are going to be understated. If we had not recorded the payable, our liabilities would have also been understated. But how did that affect equity? Well, if our expenses are understated, that means our equity is overstated. So for this first one, we're going to say liability, and that would actually be understated. The expense would be understated, and equity would have been overstated. Okay, so the second one, it says that was where we recorded insurance expense and we credited prepaid insurance. So again, expenses, if we had not recorded that, would have been understated on the income statement. What about prepaid insurance? Well, that's a credit to prepaid insurance. Prepaid insurance is an asset. A credit to an asset is going to reduce the assets. So that means if we had not recorded that, our assets would have been overstated. So in this situation, we're going to have assets overstated, and then our expenses again would have been understated, and of course our equity would be overstated if our expenses are understated. The C part said was for the charter revenue. Okay, so we had debited accounts receivable. So if we did not debit accounts receivable, that means assets would have been understated. Service revenue was our credit, and that was an increase to service revenue. So if we had not recorded that, then revenues would have been understated. So in this situation, we're going to have assets understated, and revenue would have been understated. And if revenue is understated, then equity is also going to be understated, okay? Because that means less net income. Then on D, it said we had depreciation expense. So again, if we had not recorded the depreciation expense, expenses will be understated. But what about accumulated depreciation both? Okay, so this is a contra asset. We were increasing a contra asset. So that's a little tricky. So think about it. This contra asset is a subtraction from boat. So that means that if we did not record that, then our assets are actually going to be overstated because this would have reduced our assets. So this one's a little tricky. But assets would have been overstated. Expenses, again, understated, no depreciation expense. And equity, if we don't record an expense, is going to be overstated. Our last one involved this service, unearned revenue and service revenue. Remember, unearned revenue is a liability. Now, this was a subtraction or a reduction in liabilities. So if we did not record that, then that means liabilities would have been overstated. If we hadn't recorded the service revenue, then that means revenue would have been understated. So in this case, it's going to be liabilities, and they would have been overstated. Revenue would have been understated, and equity, of course, if revenues are understated, equity is going to be understated. And that is the conclusion of the demonstration for problem 340B.